And now let me introduce the domestic speakers. We have 4 domestic speakers. First, we have Mr. Cho Hong-rae here. He is a CEO of the Korea Investment Management, one of the top asset management company in Korea, like that. I'm sitting as a outside BOD member in this KIM. And hello, Mr. Cho. How are
Hello,
you?
good morning.
Good morning.
Good
morning.
And,
thank you for your time.
Thank you.
And we have Mr. Kim Hee-seok. He is a CEO of Hana Alternative Investment Asset Management. Hello, Mr. Kim. How are you?
Good morning. Good morning. Good to see you on screen. Okay.
Good to see you. I know you had a meeting this morning. What about that meeting? Did you cancel the meeting?
No. Delayed for some time.
You delayed because of this event. Thank you.
Right.
Thank you. And we have Mr. Won Jong-hyun. He's sitting at the chair of Investment Policy Committee at NPS. How are you, Mr. Won?
How are you? Good morning.
Good morning. Thank you. Thank you for joining us. And we have Mr. Kim Jin-woo. He is a Senior Managing Director of Sinyoung Securities in Korea. How are you, Mr. Kim?
Hello. Good morning.
Good morning. So now we have 4 of the domestic speakers. And let me open the question about the private market versus public market. Listed companies, listed real estate versus unlisted real estate. What is the issue? We believe there would be a different impact to those 2 different groups. And also, people say that the listed market often lead to the private market in terms of the price discovery in many times. So I'm wondering what is the impact to the listed real estate company earnings and risks, and how much they will be impacted by this downturn. And can we compare that to the private market? Who can start first? I think Mr. Ferguson, can you start on that first?
I think I've got some perspective there. Normally in discussions like this, I might quote the famous economist Samuelson and say that the listed markets have forecast 7 of the last 3 economic recessions to make the point that sometimes there are head fakes. But I think it's undeniable in this case that we are heading to a global recession. And I do think it's true that the listed markets often lead the private markets. That said, the magnitude of the moves in the listed markets are often exaggerated. And I think right now part of what investors are faced with is a 30-35% sell-off in listed real estate. So that's a net asset value, but it still implies a roughly 20-25% decline in the underlying gross asset value of real estate in the listed space. Is that a reasonable price adjustment for what the impacts of the COVID economic downturn will be? And to put it in real estate speak, we've seen cap rates widen by 50 to 100 basis points depending on where you're looking, and that's cap rates applied to earnings adjusted for the likely impact on earnings that the economic downturn will have. And to answer my own kind of question there, I do believe in this case the listed market has overshot the mark by a reasonable amount. We've been through an extensive rewrite of our earnings for both this year and next year for listed real estate companies. And in some sectors like hotels, we see the impact on earnings being, more than 55% decline. So it's very significant. But if you take the weighted average of real estate across all the sectors represented in listed real estate, the cumulative impact is more like 7%. In places like data centers and towers, we've seen an impact of only 1 or 2%. And that's basically just because we're cutting back the amount of investment activity that they will likely do. And in many of the other sectors, the impact is more like 5 to 8%. The other major exception is retail. In retail, because of higher tenant deferrals or defaults that we see, we estimate almost a 20% reduction in earnings. But again, in the listed space, retail real estate today is only about 7 or 8% of the market. And so it really doesn't explain why there's this sort of overall 25, 30% decline in real estate. And that's why we've seen a number of our institutional clients of not only the Clarion listed real estate securities business, but for global investors lean in thinking that this might be an opportunity to invest when the market has in fact already discounted and maybe then some the likely impact of the COVID crisis on real estate cash flows and values.
Thank you. Thank you. You mentioned the hotel and lodging and retail. They have the worst situation at this time. And well, a couple of days ago, I saw the news about AHLA, Alberta Home and Lodging Association. They put new guidelines of the cleaning, the lodging and hotel services. Do you think is that kind of actions affect the real estate market in that section specifically?
Well, that speaks to some of the
concerns.
Yeah, that speaks to some of the increased costs of maintaining. But right now for this quarter and next quarter, it's really that a majority of these properties are closed. And those that are open are operating at 15-20% occupancies. There is no lease term to speak of in the hotel sector. Most other sectors have at least a few years of lease term to protect some of the cash flows, but hotels are essentially released every night. And so that's the big issue now. And our forecast is that likely for the balance of the second quarter and a majority of the third quarter, those occupancies will be at very depressed levels. But to your point, when it does return, there is going to be more caution by the business traveler, who will be motivated by corporations that increasingly will be looking at how to control costs and will ask good and hard questions about whether business travel needs to be at the same level as before. Leisure travel will also be impacted by, whether leisure travelers feel comfortable. And they won't feel comfortable if there isn't a much higher standard for cleaning and other kind of hygiene things that just adds to the cost basis, unfortunately. So lodging is caught between both a demand destruction and an increase in cost that make our view of the likely recovery pretty pessimistic.
I see. The following question I want to ask you and Mr. Cho Hong-rae from KIM. And how do you think about the listed real estate, the public real estate companies' earnings these days? Are you guys affecting? How much affecting from this downturn as the company earnings in the real estate side? Mr. Cho, could you? Yeah.
Yes, because of our past, business track record, I do not have enough knowledge base to make a mention on this sector of the market. But we've been we've been doing business mostly in two parts. With the institutions in Korea, and at the same time, deep into the mass market or high net worth market. So I'm just telling my view on the potential expectation from the part of the mass market or high net worth market. So we do have other colleagues in this conference from MPS or other gentlemen who can represent those institutional markets. From the viewpoint of the high net worth or mass market, the listed real estate companies like REITs or some others, well, it is a legitimate investment opportunity for them. But at the same time, they have been traditionally, they've been mostly interested in investing directly to the properties overseas. That was from about 4 or 5 years ago. And the Korea Investment Management, my company, has been pretty active and was a good shape in that area during the past 4 or 5 years. So at this moment of time, in the middle of COVID-19, we do not have, material differences or material differences or some other important factors rising from the high net worth or mass market, because still there are so certain huge amounts of uncertainties in the real estate market or around the world. So at the end of the day, my bottom line answer to your question is that I need to wait and see, and we need to contact with their major channels in order to figure out what the investors are thinking of. But we do have one potentially good news in terms of the investment appetite, because in Korea, we already have the historically low Bank of Korea rate, and everybody is just forgetting about 5 or 6% per annum expected return. So potentially, our expected rate of return would be like 4% or even lower than that in the near future. So, but at the same time, because we do have a relatively abundant money supply, and we have a mounting amount of the pension market. So the appetite for the overseas property investment, it's going to grow in the future for the next 5 to 10 years, definitely. So and also I do have, Mr. Chung, I do have another question actually to you and other gentlemen here. May I?
Yes, please.
Okay. Yes, very quick questions. 2 questions. One is the lending market situation, because traditionally the Korea's individual investors tend to invest in equity instead of mezzanine or loans.
Yes.
So we've been enjoying the situations overseas, like in the US or in Europe, with LTV, like 60% or 65%.
Mm-hmm.
So I'm not pretty sure about what's going to happen in this regard. And my second question is, well, the real estate business is the contact business. We need to physically contact with people and buildings.
Right.
So is there any other way to get into the untapped paradigm in the real estate market? I mean, technically speaking, like untapped due diligence or things like that. So if you have come up with any ideas, please tell me. And also, I like to make a very good, say hello to people from CBRE and Giller, because we've been buying properties in the US or Europe or even in Japan during the past 2 or 3 years with the help of those 2 companies. Thank you.
Thank you, Mr. Cho. And very interesting as always. You mentioned about the equity investors, equity holders to the US market and European market investment. What would be their optimal scenario or strategy at this time? Can they exit properly? Because under this downturn market, they must have a huge problem. So the idea about the equity holder in the real estate market, well, I think that's first question. And second question is, how can we do the business in the real estate market in global world and under this situation? Who can say that? Who can answer that question?
Well, I can add up a few comments on what you just said. Well, basically, I think the investment appetite from the individual investors in Korea, they will they'll go on and on and on. I'm pretty sure of it. But there are some reluctance level inside their mindset in two senses. Obviously, because of these, these days economic situation around the world, we do have some troubles. Not our company. I mean, everybody in the market have some trouble cases in investment overseas. So that will, because of this kind of news flows, the investment mindset will be a little bit shrink for the time being. Maybe by the end of the year or so. Well, but the time is our friend, so so I don't have much concern about that. But the second thing is, they do have concern about the midterm, not exactly the very long term, but midterm economic view on the global economy, like next 2 or 3 years, which is very crucial factors determining whether or not they are going to invest their money into the overseas properties. But overall, at the end of the day, I think they will come back after some, if we have some success story, especially if we have some success story of exit. And in this respect, our company, Korea Investment Management, hopefully we can make several success stories to our client investors from their past investment, which were made 2 or 3 or 4 years ago. And at the same time, the individual investors will go through kind of a rebalancing process in their investment strategies over the various sectors, such as core CBD offices or satellite logistics or hotels. And at the same time, from different angles, they need to stick to the equity investment, or they need to switch to mezzanine or loan investment. And that's interesting aspect of the market, which will unfold for the next 1 or 2 years.
Sam, may I ask a question of either you or Mr. Won or both of you with regard to National Pension Service of Korea?
Brant, Brant.
Yes.
Before that, I would like to hear the answers for Mr. Cho's question. Anyone can answer that question?
Sure.
Mr. Cho raised a couple of very interesting issues here. Jeff or Ritson? It's Riaz?
Yep, I'm happy to. We're in the transaction business, and actually we've been having, so there's a lot of different questions that were put forth. So one of them was, how do you buy real estate without making physical contact and being able to see the real estate? And that is, of course, a problem that most international investors are dealing with right now. And it's very interesting because we're specifically from Korea, and I would say from Western Europe, primarily Germany, there's a lot of interest right now to be looking for long-term let assets. So because there's concerns about not being able to underwrite in the medium to short term, if there's a long-term lease with the credit tenant, there seems to be a fair amount of interest at this very moment. Part of it has to do with capital preservation, and also because the expectation is that interest rates are going to stay lower for longer, and the returns on those types of assets with long leases and increases in rents over the lease term will be attractive, because cap rates for those type of assets are not going to go up. If they're going to either stay where they are, or they're going to perhaps come down if interest rates keep going down. So as an example, you have Amazon credit, you got FedEx credit. So we are marketing a few deals. Actually, we launched them this week or last week because there was a demand from Korean and European investors. So the question is, because we know the Korean investors, we believe they have to see the real estate. And so we are working on virtual tours. We have some technology that will allow you to obviously look at the real estate, get into the buildings, look at the space, look at where the street view, looking with Google. So there are some technologies that are being put into place. The question is it a policy that you need to be able to say, I've seen the real estate? So if you take the German open-ended funds who buy similar real estate, long-term credit income, the government, the German laws require the appraiser to actually see the real estate when they're doing the appraisal. And they have actually passed some changes temporarily to those laws that will allow the appraiser to not have to see the real estate before the transaction closes, but can see the real estate and sign off on it, within X number of months after the transaction closes. And it makes a big difference if the investor has offices in the US or in Europe. So they have boots on the ground, so to speak, where people can actually go see the real estate. So of course, if you have a presence here, it's a lot easier. But if you don't, is it a policy or a regulatory issue, or is it more of a business decision? That's going to drive whether investors can actually close on transactions without having seen the real estate. So that's number one. I think the other question was about leverage and whether 60 or 65% leverage is still available. The CMBS market right now is shut down, but generally speaking, the leverage levels have gone down from 65 to say 60%. But one of the big things that drives these returns for Korean investors is also being able to get debt that gives you interest-only debt service over the loan term without any amortization. So that's going away for now. The lenders are becoming more conservative, and they're not offering these 10-year interest-only 65% loans, which affects your cash-on-cash returns, which I know are very important to Korean investors. So those are two out of a few questions that were asked that hopefully, I don't know the answer if one is able to come and see real estate, but we are working and we have technologies that allow you to do it virtually.
I see. The virtual business, virtually. But let me ask Mr. Kim Hee-seok.
Yes.
Personally, do you think is it possible to make an investment decision without seeing the buildings, actual real assets, without touching that, without visiting the spaces?
About that, my personal opinion. Do you hear me?
Yes.
Yes.
Clear.
Okay. So just in this situation, we also thought about the virtual due diligence, or based on that, we hope the based on virtual due diligence that the investment will be done is best way for us. However, the problem is that investor side they have a regulation. So usually the Korean investors that they their regulation that they have to see the site, and
they have to see
also
the sites.
See the site.
It's mandatory. It's a required
mandatory
regulation.
That's the serious obstacles for the investment based on the virtual due diligence.
I see.
So, however, I think that this a lot of people are expecting that this kind of a pandemic, the disease will be happened again. So I guess that maybe the investors will change their stance, their regulation. So in 3 or 2 years later, maybe based on the virtual due diligence, the actual investment can be done. So I think that if we use very the global the advisors who have a great reputation, so I think that when investors meet with the advisors or see the sites that actually they almost nothing to confirm the facts or situation. So the important thing is that the report given by the advisors who has the global reputation, is the most important, I think. So we would like to persuade the investors that the due diligence by the global advisors more important than seeing the site.
I see. So as a result, to the role of CBRE and JLL,
Right.
global advisors, is getting more important.
More
these days.
important.
I might just draw the connection between not being able to see the real estate and it being too early to invest in real estate. Because if you can't get to the real estate to see it, it implies that we're still in global quarantine, or at least people's behaviors are affected as such, which means we're still in a value decline, income decline, and we use the expression investing into trying to catch a falling knife. So with the markets continuing to erode, at least for the next 6-8 months, maybe a year, not being able to see the sites is an indication that we're still in lockdown. So how do you invest? How do you consider putting capital into that situation? Period. My advice would be you don't. I do agree with Riaz's point. Look, if you have a 15-year triple net lease to FedEx, okay, well that's a bond. I don't even know. That's not even really real estate in my mind. But if you're going to buy real estate, I mean, I've said this for my entire career. I never think of a property the same way after I see it.
I see.
In due diligence, it's I either have a better opinion of it or a worse opinion of it, and its value and its cash flow profile. But it's never the same. So I don't know how you buy anything without seeing it. And if you can't see it, the advisors can't see it either. So I mean, that would be.
I see.
My opinion.
Thank you for your honest opinion. Mr. Joe and Mr. Ritson, do you have any comments on that? So Jeff said StepStone don't want to put their capital without seeing the actual property.
Yeah,
I don't have any specific comments on that. But even though we have technology of virtual reality for the due diligence in the future, we still have some technological homeworks in order to protect ourselves, the market participants, from the potential hackers. I've been watching too many movies too much, and there are several movies showing the virtual reality fraud or things like that.
I see. Thank you, Mr. Cho. Ritson, back to you.
I think a lot of good points have already been made. The only thing I will say is I think the point about what the role of the advisor is and what you depend on the advisor for is a good one. I can assure you that CBRE never invests in a property that we haven't seen. And despite the travel restrictions, parts of the world where our direct investment teams are in fact doing due diligence, and we are closing. But for a lot of the reasons that I think Jeff was describing, I would say the level of investment activity on our private side has definitely slowed, because we're in that typical market phase where, again, listed markets have made their move. Unfortunately, listed markets in a time of uncertainty tend to solve for the lowest common denominator, so they've assumed worse. I think buyers' expectations now are that they ought to get a better deal, so their bid has become, less compelling. And sellers, rightly, are still waiting to see how much of a concession do I need to make based on where cap rates will settle and where cash flows will be affected. And there right now is just too much uncertainty for that bid-ask spread in the private market to be resolved in many cases. So I think it's appropriate that, unless you're buying a bond, real estate, that a lot of that transaction activity has slowed. But that does present some opportunities, and I think if you've got the right investors doing the right work for you, you should be able to still proceed.
Got you, Ritson. Thank you. And now back to Brant. You want to ask something to Mr. Won and myself regarding NPS? So because Brant want to say about our National Pension Service, what's going on here in this under this pandemic period. So, do you have anything to comment on that, Mr. Won?
Yeah.
Mr. Won, can you start again from the beginning? I lost you.
Can you hear that?
Yes, now it's clear.
Can you hear me? Yes. In my case, the alternative investment is very special vehicle for me. So I don't have any idea is the alternative investment vehicle, but we have focused to the social investment and the ESG, and we have with we wanted to have any ideas. So the ESG, how can the link to the alternative investment in this case it's a situation of a pandemic, so it's a very low growth situation is I remember this as the speaker of Brant. I have a big interested in some we have some social responsibilities for the investment, especially is the alternative investment. So we think we believe is more efficient vehicle in this case. So on. Thank you.
I see, Mr. Won. And well, you just raised a very interesting issues, and which is big issue, but a little different issue than what we are discussing today. But let's talk that the ESG and social responsible investments, maybe today a little bit, and then we may have another chance in the later. But why don't we touch that area? Can we link AI, alternative investment, real estate investment with the ESG? Anyone have comments on that? An idea? Socially responsible investment. I heard there is a green energy investment, something like that.
It's the many varieties of vehicles is the green energy or the blue round with the blue round industrials or we have focused to just only the securities we have to the focused in the many securities, but the alternatives we believe in some the non-securities, in some the direct investment in this area we can believe.
I see.
So, and then
anyone have a comment on that?
Well, Sam, I'll make a comment. You know, first, some of the green investment and all that, you know, we are a platform that also invests in infrastructure, and our infrastructure space are very active in renewable energy and the like. And for that matter, in listed infrastructure strategies, you know, we are both investors in entities focused on green energy like that, but also using our position of influence, trying to influence the utilities and other users of energy to convert towards more sustainable forms. So I think those themes are very much alive and well. And I'll tell you, more generally, we believe ESG isn't a fad. We believe that, you know, a focus on ESG is important for identifying investments that in the long term will be better investments. And it's very much built into our kind of investment disciplines on both the public side, the listed side, and the private side. And historically in the real estate space, a lot of the emphasis was on the energy consumption. So it was on the S, but increasingly, or on the E, but increasingly the S and the G are an area, the governance and now the social. I think it's quite interesting that a number of the listed companies have set up funds, you know, to help the disadvantaged, that a number of the real estate owners are doing things for rent forgiveness or rent deferral and things like that, that very much are in that category of, you know, being socially responsible. And I think that will have a benefit for investors in those companies, those that are doing it well. So I think ESG is something that needs to be built in. It certainly is here at CBRE into a successful investment program.
We all agree on that. Yes.
Sorry. I think basically we MPS must be increasing the alternative investment because it's two reasons. First is that the alternative investment is guaranteed for me, for us, it's a more interested rate and yield. And then second, we are front of the pool of the securities in this Korea, just in Korea. So we need this alternatives investment. We must so that, but in this area is we don't have interested in the social responsibility. So we just only in this eventually so we will increase the alternative investment, but and I want to earn some include some social responsibility, just only one.
Right. Thank you. I agree that. So SRI and ESG will be a very important issue. And as the Ritson said, supposed to be built in business strategy, our product and strategy in the future. So we will have, I'm sure we will have a chance to discuss about the ESG and SRI linked to the alternative investment space in the future. And now I think we have almost end of the session. We have about 2-3 minutes. Why don't I ask all of you if there is any recommendation or suggestion to local investors from the global investors' point of view, or from local investors' point of view, do you want to hear anything more from our
thank you for
side? Yeah, Mr. Kim Ji-woo.
Mr. Jung, thank you for giving me a chance to talk about my opinion. So, post-corona, everything is on the table, I think. In overseas real estate investments, Korean investors are surely, I think, biased toward single projects with a single tenants. So I think post-corona, blind pool funds and multi-tenant deals might become popular. And secondly, investment horizon, Korean investors are a little bit short. So it should be much longer, at least 10 years, to go through these kind of slowdowns. Thank you. That's my
I think Mr. Kim Ji-woo is asking about the kind of the preference or tendency of the Korean investors to foreign the real estate investment instead of the multi-tenant, single tenant. Are you saying that?
Yes.
So Korean investors tend to prefer single tenant long-term investment.
Not so long. Usually, Korean investors are investment horizon is
It's less than
5 years.
It's less than 5 years. It's less than 5 years. How do you think about that kind of the tendency, Jeff or Ritson?
No, I think it's a fantastic time to invest in single tenant credit, triple net lease properties. It's one of the strategies that we're supporting and recommending. It's a great way to bridge the risks of the downturn. I had mentioned, the catching a falling knife scenario where you don't know where things are going. So investing now is with peril, but if you invest in long-term triple net lease projects. Right. Even, I know this is not necessarily the Korean approach, but I would also espouse putting leverage on those long-term triple net lease properties up to 60-65%. If the income stream is secure, you can really enhance your returns with comfort by leveraging those positions up to something prudent, 60-65%.
We all know such a product, such an investment is a great product, the high quality and single tenant long-term investment. But where can you get such an investment? We are competing with the global asset management company in the real estate market. I'm not sure what is our competitive advantage or ability to get such a good investment in the future. Mr. Cho, do you have any comments on that as a AMC?
Yes, I am. I don't think, coming back to the issue of the single tenants versus the multi-tenants, from the viewpoint of the high net worth market, well, obviously Mr. Kim's comment was correct, but the thing is, it's changing. So people are, well, from the textbook knowledge, we know that there are pros and cons on a single tenants and at the same time multi-tenants. So the investors and the channel distributors who are representing those investors both are started to focus on the weighted average, so-called whale, weighted WALE, things like that. So and also they do have their relative advantage of the multi-tenant properties. So the distinction between single tenant and multi-tenants is losing its importance in the future. So and at the same time, the location is always prevailing in their decision making, and that's what I think.
Urban versus suburban.
Beg your pardon?
Urban versus suburban, the location.
Oh, well, if you just focus on the core office properties, then the question is invalid. Then, but especially it is a sector of the logistics. Then obviously suburban or even urban logistics centers like Amazon's logistics headquarters or things like that. So one thing clear is that investors are expanding, and they like to expand their opportunity set. So again, the distinction between urban and a suburban area doesn't make much sense in figuring out a future unfolding of their investment decisions. So location and fundamental analysis, they are everything.
I see. Location and fundamentals within the sector.
Thank you, Mr. Cho.
Thank you. All right, thank you so much. We have 1.5 hours already. Any other comments to add? Brant? Jeff?
I'm just happy I got back on.
Yeah, you're back on. Thank you. All right.
Thank you, Sam.
Thank you. We appreciate your time and interest and effort for this
It's been a
webinar.
pleasure.
And
Thank you very
Thank
much.
you for including
I'll
me.
keep in touch with you. Please be safe and healthy.
You too.
You as well.
Thank you very much.